Welcome to the Small Giants Fishbowl. This topic is how to preserve mission and values through exit and growth strategies. In this fishbowl discussion, Michael Whelchel, co-founder and managing partner of Big Path Capital, and Matt O'Hare, founder and CEO of Vital Farms, will highlight exit and liquidity options for small giants, with a special focus on how to preserve mission through your company's most important financial transactions. Okay, here we go.
I want to say a big shout out to Small Giants for having us, and also them being such a great resource to the community. And really excited about being here, and also getting to see, this is my first time of doing a webinar like this, to see so many friendly faces. It makes it easier. So yeah, and we're excited about Matt and I being here and getting to share our stories. Again, I'm Michael Whelchel, co-founder, managing partner of Big Path Capital. We are an impact investment bank that works with strictly positive impact funds and companies. And I'm really thankful and delighted to have Matt O'Hare with us today. Matt has founded multiple companies that have made it to the Inc. 5000. And he's currently founder and CEO of Vital Farms, one of the most exciting and ethical consumer product brands out there. They've been one of the fastest growing companies in the US. And they've been sharing kind of that top Inc. Ranking with Plum Organics and Revolution Foods. And Matt and I have known each other now for how long, Matt?
Pushing 6 years. But it feels like 600, Michael.
Yeah. So we've known each other for 5 years. And, I think it was early on. I knew this was going to be a longer term relationship when I was staying at his house. It was for a prospective investor meeting that was coming up. And I had forgotten my toothbrush. And so I said, Matt, can I borrow one? And he said, Whelchel, you are asking a lot of this relationship. So that's been pretty much our MO. I get to ask a lot and continue to ask a lot of him. I'll just give you a brief agenda for this call. I'm going to make some initial comments to kind of frame the topic, and then Matt and I will give some short intros and tell a little bit about our stories to give you some context of where we're coming from. And then we're going to dig into the Vital story because there's a lot of really good lessons to unpack. And then we'll leave about 20 minutes for having, group conversation and taking your questions and having, more of a dialogue. So I'll share, I'm going to share my screen here. Let me make some initial comments first. So Big Paths, we've been around for 11 years. We worked with over 150 impact companies and funds. And one of the things that we found that's kind of ironic to us is that, obviously for most of people who run mission-driven companies, purpose is given the seat of honor in our companies. And it's really the gravitational center of our company. And while there's strategy and marketing and operations and finance and all those are necessary elements, it's really the mission, the purpose that holds that seat of honor at the table. But what we found is when capital enters the room, purpose sometimes is relegated to a seat at the back of the room, or in some cases, it's asked to leave the room altogether. And so, why is this? Where purpose in many cases embodies the founder's reason for being, it's not just in the DNA of the company, it is the DNA of the company. So why is purpose, so it's so central in so many other aspects of our company, why does it get sometimes second class status, when it comes to money and capital? And we've seen in these financial transactions, they're really vulnerable inflection points where, if it's not done right, it can have a permanent negative effect on the company. But obviously, what we've seen is that there are ways to make purpose kind of the center point, even in these capital discussions. And so that's what makes us excited about this conversation, is be able to get to share not only where it's not a negative, but it can really become a catalyst to growing your company's impact. So that's why we're really very, very excited about being able to kind of jump into some of these. I'm going to share my screen here. All right, just wanted to say just a couple of words about us so you get a context of who Big Path is. So we're impact investment bank. I've been around for 11 years, and what we focus on. It's a love letter from our attorney. Basically, working with companies, funds, and investors, helping them kind of mission align capital into both companies and funds. Worked with both, a number of different types of companies and consumer products, and also renewable energy. And then we also work with private equity, venture capital, impact funds. I want to give one quick shout out. If you haven't heard about this, it's a ranking of the top 100 impact companies. So you can find this on the web if you just Google Real Leaders 100 Impact. They'll come across that. And so what I'd like to do is, as a way of introduction before we jump into Matt's conversation and kind of a questions, so I want to share a video, a commercial that came out. It was really popular, kind of give you a feel of the personality of Vital Farms. I'm going to share that.
When it comes to eggs, there's a whole lot of clucking that doesn't really mean much of anything. Other farms boast about being cage-free. Well, here at Vital Farms, our pasture-raised eggs are bullshit-free. How do we keep the bull away from our eggs? It's simple. We give our hens some space. A lot of it. At Vital Farms, our hens get 108 square feet per hen. How much room does a cage-free hen get? About one square foot per hen. I know. Cage-free farms are just big, cramped warehouses. Those hens live their entire lives indoors, rising and shining to some industrial-grade light bulb. Now that's some bullshit. Fake story. Our ladies, they're raised in an actual pasture, in the sunshine. Here at Vital Farms, we hear that our hens get to be hens. Like whatever that is. Really nutritious eggs that are naturally free. But you don't have to take my word for it.
Cage-free? Oh, I've been eating up that bullshit for years. I fed that bullshit to my loved ones. But with Vital Farms, my recipes are more popular than ever. That's good.
When a restaurant serves Vital Farms eggs, it makes the hens happy and it makes my girls happy. Because brunch is too short for bull. Right, Allison? Right?
Mm-hmm.
Serious chefs have been using Vital Farms eggs for years. The reality of cage-free is, it's all, pardon my French, connery.
Y'all know what that means?
No, sir.
Bull. Well, I don't know a lot about French, but I know a lot about pasture-raised and how it gives hens space and sunshine, unlike cage-free. Because when you crack into a Vital Farms egg, we want you to be absolutely confident that what you're eating is 100% bullshit-free. When it comes to eggs,
All right, great. So with that, I'm going to turn it over to Matt. Matt, maybe just kind of walk us through, give us a little bit of your story, and then we'll kind of jump into some questions.
Great. Good afternoon, everybody. So Vital Farms started about 10 years ago. It was a kind of an idea. There were certain eggs. There we go. There were types of eggs that I liked, and it turns out that those eggs came from chickens that lived outdoors on pasture. And when chickens had access to a natural lifestyle and they're able to eat things besides just corn, which is what all the eggs in the country pretty much are fed, or the chickens are fed for those eggs, they end up with a delicious product. And that experience, which I experienced on small farms over the years, I wanted to find out if it was possible to scale that, to can you really make an egg and treat chickens humanely, and do it in a way where it's scalable? And so we started out with one little farm. My wife and I bought 20 chickens. It wasn't my first time raising chickens, but we started doing some experimenting. We bought 1,000 baby chicks after that, and we bought several thousand rescue hens from an organic laying operation, which is basically a big factory barn, warehouse. The chicks had to live inside all the time. We bought those chickens from them, and pretty soon we were business. It was difficult at first. I did all my egg delivery in a Subaru, which isn't really legal, I guess. But I could fit 22 cases in my Subaru with, as long as there were 2 in the passenger seat with the shoulder harness on. And and when I would go out and call on restaurants and small grocery stores, and every time I said pasture raised, they thought I was saying pasteurized, and they didn't know what I was talking about. But I was charging a price that was pretty much double what the next most expensive was, because that's what it costs to do it humanely. Slowly started making some sales after sending a lot of eggs to the food bank, because I couldn't make sales. And slowly but surely we got in there. And today, 9 years later, we are 2% of all egg sales in the United States, which is quite a distance. And it's kind of interesting just to look back on that mission. The entire time, our mission has been to bring ethically produced food to the table. That's what our purpose is as a company. And for the first time in the scores and scores of companies that I've started over the years as an entrepreneur, because that's basically what I am, as an entrepreneur, not a egg guy, I decided to start this business with a different philosophy, and that is the philosophy of conscious capitalism. I had read a short essay that John Mackey, founder of Whole Foods, had written on the Whole Foods website in 2005. And when I read it, it said, boy, this is everything I never did. It's not about looking to the exit. It's not about, looking how to get rich. It's about taking care of your stakeholders. So before we even started the company, I defined our 5 stakeholders, and that is our customer, our employees, which we call our crew members, our vendors, our shareholders. Yes, they're one as well. And then lastly, we looked at the environment and the community as a stakeholder as well. And what I found is, in what I practiced from reading Mackey's early work, was that if you pay attention to all of these stakeholders in a roughly even manner, lo and behold, the bottom line seems to take care of itself. And for the first time in the scores of businesses that I had a business that really that took off like a skyrocket. And I blame as much of the focus on our stakeholder model as I do on being in the right place at the right time, which has a lot to do with any success, luck. So along the way, we decided we needed to raise some capital, and to keep this rocket ship going, you got to add fuel. And so we looked at different ways of fueling our growth. And I ran into Michael Whelchel. I had taken companies public before, by the way, in the 90s. I'd taken companies out of NASDAQ. I had done probably 30 or more private offerings to my previous companies. So I wasn't a stranger to this process, but I was a stranger to impact investing. I knew what I wanted, but I didn't know it had a name. And when I met Michael and his team back in 2013, 12 actually, end of 12, early 13, they told me, yeah, there's a community of private equity firms and other investors that only invest in companies that are looking to make an impact. And I thought, well, that could be home for me. So that's sort of the background. The company has grown tremendously. We've got a great crew, but this focus on this call is really about the capital raising side of the business. A couple things. One of my philosophies is that just like every human being dies of a heart attack, whether you like it or not, you die when your heart stops beating, right? Every business dies when they run out of cash. That's the end. That's the last beat of the heart. And so I'm a firm believer in always overcapitalizing the company. making sure you have plenty of capital. You know, I've had my share of failures, and it's always running out of cash. So I wanted to stay ahead of that curve, and so, but I also wanted to try something different, and that is what would happen if you run a company where you look to, instead of waiting till you sell the business down the road, you actually got some small exits along the way that gave you liquidity, that gave you, satisfied your, you know, a little bit of a ability to buy some things you want in your life besides just supporting the business. And so I looked at setting up a process where we do small exits along the way. I wouldn't call it an exiting. I would just sell a little bit of my stock and other founders' stock and other investors later on. So the first transaction I did with Michael's company back in 2013 was to sell well, actually the second transaction. The first transaction I did was in 2009. I sold 20% of the company for $200,000. I can't tell you how rich those people are today, but they are. But it was a great transaction. I don't begrudge it, because I look back at it today and I said, well, you know, I got 100% of my early investment back, and I felt great about it. And so a few years later, I did another transaction similarly with Michael at a much higher multiple, but sold 10% of the company. And that process has continued over the years. Every few years, I'll do a small exit now. You know, the valuation today is, you know, many 2009 or 13. But I've taken a little, you know, give me the freedom to not need to sell the company. And along the way, as the company needed capital, they participated in the offering at the same time. So if we were raising, I sold a little bit of founder shares or other shares, but also the company. We built a $17 million egg packing facility last year. You know, so we raised capital as we needed along the way. But the focus has always been on impact investors. So only private equity firms and individuals who understand our mission, understand our focus as a conscious capital company, and it's surprising to me how many of them are out there. There's a few posers, but in general, there's plenty of capital looking for companies like ours. So it's been a fun process. I spent a lot of my time on it. The transaction we're about to engage in later on this fall will be 9 figures, which would give liquidity to early investors, including early private equity that came in, and some founders, and bring in new lifeblood into the company of companies that are excited about what we're doing as we go forward.
That's great. That's great. Matt, yeah, thank you. So I heard you say one time, someone asked you the question, what's the difference between traditional investors and impact investors? And you said it's not what they do, but it's what they don't do. And I just wanted to see if you could elaborate on that.
Yeah, I mean, it's funny. I had a friend, I met a gentleman on a flight. I was coming from the Berkshire Hathaway annual meeting, and I was on the flight, and the CEO of Dairy Queen sat down next to me. And Warren Buffett owns the company. I said, what's it like being CEO of a company where Warren Buffett is your only shareholder, your boss? He said, yeah, it's only he and I on the board. I talk to him once every 2 years or so for 5 minutes, and I have unlimited access to cash, and I continue to build the company. And that reminded me of, I had asked Warren Buffett what is his favorite perfect board of directors in his mind. He said, me and 11 Helen Kellers. So what sometimes a private equity partner will do is they'll come in and try to run your business for you. So that's when I say it's what they do, not what they don't do. So if they're not there, you're not looking for someone to come and run your business. They're investing because they believe in what you as the jockey of that horse. You're looking for people that want to invest in your mission and not try to oversteer the ship. But further, you're also looking for private equity investors who aren't looking for the quick exit and will allow you to make decisions that are not always favorable to your bottom line. And that makes a big difference. I'll give you a quick example. A couple years ago, about 3 years ago, 4 years ago, there was the egg industry in the United States got hit with avian influenza, and 45 million chickens were killed. As opposed, I mean, they're mainly put down by the USDA. They're mainly factory farms. And so what happened is the following year, the ones that weren't killed, everybody overproduced. And so there were so many eggs in the market, massive amounts of eggs, and it hurt demand. And we were in a situation where we had over planned ourselves. And so we had too many eggs and not enough market for it. And our contract allows us to basically tell farmers, see you later. You know, we don't need you to produce for us right now. We're not going to do another flock with you. But instead, I went to my board and I said, I would like to spend $6 million paying these farmers to not produce for us over the next year. It's going to wipe out EBITDA for the year, but I want to know, this is what I would like to do. We had 100% support. The 7 private equity members of my board of directors, 100% support for what we did with the farmers. And getting farmers is one of our most difficult tasks in the past. Today we have 350 qualified farmers on deck ready to build, spend an average of $1 million each to build out the facilities they need to grow humanely raised chickens for us and produce eggs for us. 350, and that's because, so it's kind of a byproduct. It's not the reason we did it, but because we treat our farmers, you know, like we'd want to be treated, it's had a tremendous impact.
You know, maybe they're more patient or kind of focused in on the, you know, more the mission and how that adds value to the company and maybe a longer time horizon. Any other kind of characteristics that you see as distinctive to more traditionally minded investors?
Like, you asking about what other type of characters I'm looking for in other types of investors or private equity?
More just like, you know, other differences that you see between traditional investors. It sounds like, you know, time horizon is one, longer time horizon. 2 is there's an understanding between the mission and how that creates, you know, real, you know, financial value. So there's a better understanding of how that works. But I'm just wondering if are there any other differences that you see?
You know, not that many really, because it's important that we share up front what our mission is, what our purpose is as a company, and they have to buy into that. And if they don't buy into that, then we won't even work with them. But once they're on board, these are professional. They're money managers. They're taking other people's capital and they're looking for a strong initial rate of return, somewhere, you know, between 15 and 20% annually. So they want to know that you're doing your job. So, you know, a lot of our meetings, you know, we talk a lot about our mission and our purpose as a company, and our deeper purpose. But at the same time, you know, a company that's not profitable isn't sustainable for the long haul. So they want to know that we have good business practices, that we are paying attention to all of the things that normal businesses have. And that helps us be a better company. So, you know, we've got an audit committee, we've got a compensation committee, we've got a strategic advisory committee on my board. So we run our company like a public company, but with one trading day a year, so to speak. Where, you know, about every year, 18 months, we do one of these offerings, and that really makes, because everybody like takes the gun away from the head. If you got to sell the company, you got to find a buyer.
Yep. That's I mean, you bring up a good point, because I think at least we find the people that are maybe new and looking at mission, you know, related investors, mission-driven investors, feel like it can be easy money in the sense that their financial expectation, return expectations are different. And there are some out there, but in general, we found that it's, you know, the financial return expectation is very similar to traditional. And it just depends on, you know, what asset class. If it's venture capital, it's a little higher than it's, you know, growth equity versus later stage. But it's almost like it's an added layer in their financial or in their evaluation of a company. What, you know, having gone through, I mean, you've obviously, you know, you've started multiple companies. You've had a lot of different capital raise. What would you know, what do you see as the most important pieces in that process? And what would you have done differently, whether it be in Vital Farms or one of your other prior companies around bringing in capital?
Well, obviously, bringing in capital is sort of like hiring employees. It's all in or growing something in regard. The seed is the most important part, in a lot of sense, and the till prepping for the growing cycle, not just the growing cycle. So finding the right investor group is really important. But even before that, finding a good, I highly recommend that people look to get a investment banker in the process. A banker will take a lot of the pressure off the process for you. They'll do a lot of the work that you think you might have to do yourself, and they're going to get you a much higher valuation and help you vet the private equity or family offices that might be writing the check. And so that take all that weight off. Now, it doesn't mean that you're not going to spend a lot of time in the process, because you will, but it is, but you'll spend 75% less time if you have a good iBanker. And since they're going to get your higher valuation than you get on your own, and bring multiple parties to the table with term sheets, they'll pay for themselves many, many times over with valuation. So that's the first step I tell everyone that comes into this process. Get a great investment banker, get someone who specializes or works with impact investors, and then and by the way, you need to vet them. You need to make call references. That process is really important. And then they will bring, they'll start, the process will be building a deck for you, building a data room so that the investors can look and see what the numbers are, populating that data room, putting together a buyer's list that people are going to potential invest, whether it's, and we'll talk about this a little later, type of investors, whether it's impact, whether it's private equity, family offices, strategic investing, and then you editing that list, crossing people out you don't want to deal with. There was one interested in billions of cage 10s in there. That's okay. They might pay us a lot more money for our shares that we're offering, but I don't have any interest in dealing with them. So you get to edit that list, and then the sales process starts. They send out the feelers, people do indications of interest, and ultimately term sheets come in on a prescribed date. You review those, maybe negotiate with whoever you're going to be dealing with, and then go to closing.
Cool. So on that topic, I'm going to go ahead and share my screen to show this one slide I think will help in the conversation. Yeah, so Matt, you've brought in a number of different types of investors, family offices, private equity, strategic. So I'm just curious, these being, kind of the large buckets of potential investors or even acquirers, if someone was looking at a majority control transaction. Can you just kind of speak to a little bit of, in your opinion, what you've kind of found in each of these different categories, and why one could be more attractive or not attractive in your situation?
I'll go right to what I think is the most attractive, and it's one we haven't done yet, but it's a holding company. So the idea of a holding company, the best example is Berkshire Hathaway, Warren Buffett. So here's a company that that owns so many great companies in the United States: See's Candy, Justin Boots, Geico Insurance, Dairy Queen, on and on and on. And they buy and they hold. They don't look to sell. So they're a source of capital when the company needs it, and you have one shareholder instead of a million like you might have for your public. So I think that's the problem is there's not enough of them out there yet, and I think you'll see that'll be a very fast growing area over the next 10 to 20 years. You'll see more holding companies. People don't realize the damage that it causes, or the friction that caused when these private equity firms buy and sell. There's tax that have to be paid. You're starting all over again with a brand new management team next time you invest, etc. So I think it's going to be a really great future. But there's not enough out there, like I said. Impact family office. As most of you know, family offices are kind of a place where families invest together. They have professionals on their team. They either invest in other private equity firms or they will invest directly in companies like mine. I don't know, they are, you'd be wise, again, have an investment banking firm to deal with these folks, because it's a changing world out there, and that focus is a lot different than raising chickens for eggs. You got to pick what you want to specialize in, and I think that's a good area for it. Impact private equity firm, there's hundreds of them now, well over 100. And those are the most rich source, I think, of investment. Most of our investment over the past, of the 7 transactions we've done since 2013 or 6, have been with private equity, impact private equity firms. And strategics are traditionally, in the past, strategics meaning, like the company in your field. And it would have to be, the investment for them would usually bring synergies with it. For example, a friend of mine sold his vodka company to a big vodka company, and the cost of their bottles were 10 cents on the dollar of what my friend's company was buying their bottles for. So there's got to be a certain synergy that that makes that so attractive for them. And but the problem with strategics is they usually want to buy the whole company. They want control. Although that's changed in the last few years. You have companies like General Mills that's been coming into our field, these consumer packaged goods companies are making minority investments, and Nestle has been doing that. So there's opportunity there as well. But most of the time they want to buy the company, and that makes it, that's like the end of the game. I don't want to sell the company. So I'm usually, steered away from them for the most part. But we'll talk to them, but only on the idea of buying minority interest and small percentage, and experiencing that with us.
Great. Let's do this. Let's move to some questions from the group. And Rachel, do you just want me to look at the feed and then ask those, or do you give opportunity for people to actually ask them themselves?
Yeah, sure. Well, I have one that already came in, so I can read this one to you. And then everyone, if you have questions, feel free to chat them in, and we'll pose them to Michael and Matt. But the first question that came in is, what percentage of the raises is growth capital versus cash out for current stakeholders? What percentage of Matt's stake does he sell in each raise?
I'm not sure I heard the first part of that question. Sorry, Coach.
Yeah, no problem. It's what percent of the raises is growth capital versus cash out for current stakeholders?
Okay, that's a good question. So really, it depends on the year and what we're doing. So at times we'll need capital for various reasons. We've done we acquired our entire supply base a few years back, and so that took many millions of dollars, and so we did a raise for the company there. But every time we do one of these transactions, we will offer what we call secondary stock, existing shareholders the opportunity to sell on a pro rata basis based on their percentage ownership. So that's what gave the liquidity. So we do it side by side each time. The first transaction was 80%, selling shareholders and 20% capital raise. Next time around was 100%. No, next time around was 100% selling shareholders. The next transaction is 100%. The one after that was 100% company raise. And then after that, it's been 50-50. It really depends on the transaction. I have sold a little over half of the company over the years myself. And like I said, I don't begrudge it. I don't know if you noticed, but this is where I'm working in the summertime. This is home. And I work here 3 months a year. I live on a boat. It's too hot in Texas. I'm able to do that because I got some liquidity along the way. So, and I'm still having a blast running my company. I just had my management team out here for a week. My board of directors out here last week, and So yeah, it's we've gotten liquidity for the really nice thing is we've gotten liquidity for the private equity, where they're the ones that will really come along and say, okay, our 5-year window's coming up, we want you to sell the company. And but this gives them liquidity and gives them their ability to leave if they want to leave, or stay in if they want to stay in, without having to turn around and sell out to to big business.
We got another one here through chat, and that is, what, if any, impact did you see on the culture of your business throughout the various transactions?
So yeah, that's a good question also. The impact seen on the business is minimal, provided you don't give people cause for alarm. So we really talk to our crew members about the transaction, what we're doing, why we're doing it, and the way we do it. So transparency is really important. If you just waltz some people with Wall Street people in with ties into your egg processing facility, you could get people worried. And so but on the positive side, for our crew members, we do stock options for all of our employees, and everyone who's been there for a while is offered shares and a stock option, qualified stock option plan. And qualified stock option plans usually have no value to the employee if the company's not public. How are you going to sell the shares? Well, we register those. We actually not register, but we sell those, offer them the ability to sell their shares to get liquidity with their options, with their vested options. So all of a sudden, instead of just being this pie in the sky that doesn't have reality, I've got some employees that have bought a house with their stock options, and that value really, all of a sudden they see the stock options as, wow, it's really something that's tangible. And maybe buying a house for a vice president, or it may be someone getting a $5,000 check for selling some shares who's working on the egg packing line. So it really has a value all the way around. And so that's one of the positives that happen with these transactions is the liquidity that our crew members get as well.
We have a couple of here through the chat. Can you compare and contrast the challenges of financing a scaling product-based business with a service business in, say, technology-enabled healthcare delivery? So that's kind of specific, but can either of you guys speak to that?
Michael?
Yes, ask that one more time. Is this the one? Can you compare it? Gotcha.
Yeah, yep, that's the one.
Yeah. It really gets down to, so when we look at look at the different buckets we talked about, private equity versus family office versus strategic. On the private equity, typically there is some type of sector focus. So, you would want to kind of find, private equity groups that were open or had done, transactions that were somewhat related. It doesn't even have to be, maybe not even healthcare delivery, but that they do service businesses. So they at least have kind of an imagination or being open to that. And I think so really when you look at these private equity groups, typically it's sector focus. So what industries are they focused in? Kind of size of the company and stage of the company. So is it early stage, growth stage, later stage? And then also how much money you're looking to raise. So it's a little bit like a Rubik's Cube in the sense that there's different factors that need to kind of match up and sync up for a particular group to have interest. But and then things change. I mean, sometimes you might have a private equity group that had a great deal on the service business, and because of that, they might be more open to doing something a little outside. Maybe they've never done a healthcare delivery, but since this other service business investment they went into did so well, that opens up, their interest level. So there are a lot of factors. And on the family office side, I would say it's similar, but they're less pigeonholed, where they can, if it's something that they really, really like, they don't have to be, it doesn't have to be in a square box, for them to get interest and take a look at. Rachel, would it be okay to maybe open up questions also just from people, they can unmute and ask the question, have a little more interaction?
Yeah, of course. So if anyone has questions, feel free, just raise your hand if I can see you, or just jump in if you're just on audio. Give it just a second here. We have a couple more questions via chat that we can pose as people are kind of figuring out audio if they have a live question. So Matt, this one is for you. You mentioned that you believe in overcapitalization of a company. When you were raising capital, did you request capital for a 3 to 5 year run rate so that you didn't need to spend time raising capital? How did that work?
Well, I wish that we were that good at planning, but a lot of things happen along the way. For example, acquisition potentials come up, and you don't know when they're going to happen. We already are planning. We just finished our 87,000 square foot egg packing facility we call Egg Central Station last August. And we're up and running that, but we're also planning on the next one in 2020. So that we're planning for, but you can't really plan for acquisitions. That's another reason why you should always have an investment banker on your team, so that they are up to snuff on your numbers. You have a refreshed data room at all times. But I segued. What was the actual part of that question?
So did you request capital for a 3 to 5 year run rate so that you didn't need to spend time raising capital? How did it work?
Yeah, with fast-growing companies, it's really hard to get that far ahead of it. And you don't want to go too far ahead because, it's a valuation question. Our valuation has grown by 300x over the past 10 years. So, I'm glad I didn't raise it all back in 2009, right? So you want to kind of raise it as you need it, but not get behind the curve. So I look at it as part of kind of a 2-year window for us, and I will do special raises for special situations along the way. So, but because I have a refreshed relationship with the investment banking firm, you always have that available, so that if you do need to do a raise, it's not a 1-year process, so you can get it down to 3 to 6 months if you need it, and even less. The other thing you have is for short-term and really immediate needs. Once you have a couple of these impact investors on board, or even one good one, you can just turn to them and say, I need $3 million to do this deal. And it's a negotiation with your own private equity firm. They know the company. They're usually on your board. They have a fund of cash that they have a mandate to invest. So that's important. The other side of it, though, is, I guess that's the main part. You just want to make sure that you have enough for your, I would say 24 months. It's a good window.
Awesome. Thank you. We have another one here. Who are some impact investors that you love for consumer packaged good companies making less than $2 million in revenue? Any recommendations there?
I think when you're less than 2 million, you're probably in the venture capital realm as opposed to private equity. But with that, I would say that even though there's probably
breaking up.
Venture firms that are looking for deals like yours, the timing and fund will change on various company sizes. So, example, you may have a fund that has it's $100 million, and they're looking for deals of between $1 and $3 million revenue companies. So you narrow that deal down, and then you have to find out where they are in the history of their fund. Their fund may be almost petered out, or they may be just getting started and they're really hungry. And then what they've sold their investors on, remember, they're out there selling, they're raising the money for their fund, so they sell their investors on their business plan, which is, I'm going to invest in companies like this guy over here. And so they've narrowed that down as well. So again, that's a changing, very dynamic situation. And I hate to keep coming back to this, but it's true. You want to have an investment banking firm to guide you. There are a number of them out there. That's the way you want to go about it. You don't want to, in my view, I advise everyone that I talk to, let them do the work, let them vet them, let them bring the ones that because they know the condition of these funds right now, the time that where they are in their time flow. And they know which funds are focused on $1 to $3 million companies. And they know which ones require that you have a positive EBITDA and those that don't give a shit about that. They'll do that vetting for you.
A couple names. One is up in Vancouver, Renewal Partners. would be one that, and it also depends on how fast that company is growing. If they're, if they were 1 million last year and they were 2 million in revenue this year, going on to 4 million is different than if they'd been 2 million for 5 years. That would be a different story. But in general, Renewal Partners is a good one. Another group called New Ground Ventures. If you know, there's a group in San Francisco called Radical Impact that does kind of earlier stage, smaller transactions, consumer product transactions, and also Greenhouse Partners are a few that would, could invest. I'm assuming that at a 2 million, it would be kind of like a $1 to $3 million type of investment. But those are some that would fit that.
Perfect. Did you guys raise capital through investment only, or were there bank loans as well? If not, why?
Well, the cheapest money out there are bank loans. So, I mean, you got to think. There's an old adage that said, if you really believe in the future of the company, equity is really expensive. And if you don't believe in the future of your company, equity is pretty damn cheap because you're just selling a chunk of your company. So there's no better way for most companies to raise capital to get your 5%, 4% bank debt, because our company's been doubling in value every year, so that money's costing us 100% interest a year, so to speak, as opposed to borrowing money at 5%. The problem with borrowing is you got to pay it back. Simple as that. That's the problem with borrowing. You don't have to pay back until you sell the company or until you sell their shares to somebody else. But the payback comes when you're getting less for the sale of your company or less for your stock because you have, or if you start paying dividends, getting less percentage of those dividends because you've given up those shares. So a combination of what really makes the most sense to most businesses. Private equity or transaction with equity will beef up your balance sheet. And so it gives you positive net worth, it pays off debt, and it makes you look good, and it helps you get more debt, bank debt. So they really go hand in hand. You want to stay away from high interest debt, obviously, but standard major bank debt right now is costing, I think we're paying 4% and change. We have a $20 million credit line with a major bank, and we use it. We use that instead of going to the next round, unless we get a big situation that comes up, like an acquisition, or we want to build something that we think will really enhance our business.
Thank you.
One on that topic, I think if there's also kind of like, where you can delay. I mean, there's two sides to the coin. There's the side like Matt had articulated, don't undercapitalize yourself, because it's your lifeblood. The flip side to that, the balance is, you want to kind of wait as long as you can to raise capital. One is because you're going to give up less of the company, assuming you're growing, you're going to give up less of the company the longer that you wait. It's a bigger deal, especially if you're bringing in your first outside investor. It's a big deal to, you're kind of adding a new person to your family and someone that's going to be around a long, long time. So there's two sides to it that you got to weigh out. And that's one piece where if you are able to access debt, that can help you kind of postpone that decision, that what's going to affect your valuation, and just, bring in, but, obviously the flip side is if things don't go well, you have a situation where the bank, is going to be, moving and having kind of more of an ownership position in your company. So it's just a lot, there's a lot to think through, but I mean, those are kind of the both sides of the coin.
Okay, and then we wanted to give it another call to see if anyone had any questions that they wanted to pose out loud, live. Give it just a minute for anyone to unmute themselves or raise their hand. Okay. Well, do you guys have anything, Michael and Matt, anything that you want to add for the group here?
I don't think so.
Yeah, I don't think so. I think, there's an article that we did, more of a case study article that I think gives some really good pointers on this whole topic. And maybe we could distribute that. I don't know if that's possible, Rachel, but it's a nice resource, a primer on this whole topic. But no, I really appreciate everybody taking, an hour on a Friday out. So.
Okay, well that's it for this one. Check out more Fishbowls exclusively for the Small Giants community at smallgiants.org.